It is said that the average millionaire has around 7 streams of income. The average person typically only has one, usually from their job, which can put them in a vulnerable position financially. If you take a look at the average millionaire, it is true that they have more than one stream of income generating cash flow. Now, not all types of income are the same. Some are active, some are passive, some are a mix of both, some are highly taxed, and some can be leveraged to not have any taxes at all. So today, we are going over the 7 different types of income that the average millionaire has in their portfolio. If you like videos about business, money, and psychology, make sure to subscribe and hit the bell button to not miss any of our value-packed videos. And let's get started. The first and most common source of income is earned income. This is what you get from a job. This includes the average worker all the way to the CEO. Many CEOs are still employees of a company. Other professionals like doctors or nurses are also included in this category. Earned income is when you exchange time for money, which is what is called active income. This can also include freelancers. Earned income is typically the starting point for many self-made millionaires. This is where the average person starts with, and it's a good way to get started, especially if your job allows you to provide for yourself and your family. But the dangerous part is staying in this category, because this type of income leverages your time, which you have a limited amount of. You only have 24 hours in a day like everyone else, so there is always a ceiling on how much money can be made in this category. This is also one of the highest taxed forms of income. Taxes in this category can go all the way up to 40% of your income, meaning some people in this category pay almost half of their earnings in taxes, depending on their income. This is great as a starting point, but we must know what other types of income are out there. The second stream of income is profit income. This is income produced by selling products or services for more than it costs to make or buy them. This is when we move from employee to entrepreneur. In the past, starting a business required a significant investment to buy or make the products, but it has become much easier in recent years with the help of the internet. Whether you sell a physical product or a digital product, if you sell a product for a higher price than it takes for you to make or buy them, you are making profit income. Now, this can be both active income or passive income depending on your business model. If you make things yourself and sell them, then it's more of an active income and a little more difficult to scale. But if you create the design of the product and you have a manufacturer create it for you, or you make a digital product, it has the potential to become a passive form of income. There are 2 types of profit income: individual or small scale, and business or highly scalable. The individual or small scale is when you either create the product yourself or flip products manually, like on eBay or Facebook Marketplace. And that is a great way to add an additional source to your income. The scalable profit income comes from establishing a business and having a manufacturer, for example, produce your products instead of doing it yourself. This way, you free your time to focus on other aspects of your company, like sales or marketing. Another recent example of highly scalable business is by using digital products. Since they do not require storage, shipping, or even ongoing manufacturing, digital products are extremely scalable. Now, these 2 types of profit income are taxed differently. If you are an individual flipping or creating your own physical products in a small scale, chances are you will be taxed the same as earned income. But if you build a business, you might be able to take advantage of many tax breaks by forming a company or a corporation. The third income category is interest income. You make interest income by collecting interest on money you lended. Now, I don't really mean lending money to your friends. This is typically not a good idea. But there are a few ways to create this form of income. From lending money to the bank in the form of a bank CD, lending money to companies in form of a bond, or lending money to the government in form of treasury bills. These are typically safer ways to invest your money, but are not the most lucrative. Many of these have between a 1 to 4% return rate per year. Now, there might be a few other ways to do it with a little more creativity and higher returns, but a lot more risk. This is a passive form of income because in most cases, your active involvement isn't needed. Number 4, dividend income. Dividend income is when you invest in stocks that pay part of their profits to their shareholders. When you buy a stock in a company, you become a shareholder. Whenever the company that you've invested in reports profits, they will send a check to their shareholders, typically every quarter. As a shareholder, you are part owner of the company, so in companies that distribute dividends, you get a portion of the company's profits. Now, depending on what type of dividend you have, you can pay a lower tax rate with qualified dividends. If you make less than $38,600 in ordinary income, you pay 0% taxes on your dividend income. And it tops off at 20% if you make over $425,000, which is much lower than earned income, which can go up to a 40% tax rate. Number 5. Rental income. Rental income typically comes from buying real estate and renting it out to other people. Now, it does not necessarily have to be home rentals. This can also include commercial properties, which is real estate that can be rented to businesses, or industrial real estate, which is rented to manufacturers. Now, rental income does not have to come from real estate specifically. There are other ways to create rental income at a smaller scale. For example, many people rent equipment for various industries, or their cars or instruments, etc. Rental income is any income produced by lending a property to somebody else in exchange for money. Number 6. Residual and royalty income. This type of income is when you continue to get paid after your work is done. Whether you work on a movie that continues to be watched, wrote a book that continues to sell, or more recently, if you built a YouTube channel that continues to be viewed. Royalty income is a form of residual income. Royalty income is money you make by letting other people use your ideas or properties to make money, such as music or books. Music artists, for example, allow streaming services and recording labels to produce and sell their property to the public, therefore making royalties every time a song is played or sold or when someone buys a record. It's a similar thing when a publishing company prints and distributes a book. As long as people keep buying the book, the author continues making money. Now, there can be multiple royalties collected from the same property. A great example of this is the author J.K. Rowling. She did not only make royalties from her book sales, but also from the adaptation of her books in movies and merchandise based on her characters. Even though it's been 20 years since the first Harry Potter book came out, J.K. Rowling, the author, still collects royalties. As long as people are buying merchandise, renting or streaming the movies, or buying the books, she gets royalty payments because those products are based on her original property. Number 7. Capital gains. Capital gains income is when an asset that appreciated in value is sold. The most common ones are real estate and stocks, but there are many other assets. For example, if you bought a real estate property for $180,000 and you sold it for $250,000, you made $70,000 in capital gains income. Same goes if you bought 100 shares of a company at $20 a share and you sold them at $120. You made $10,000 in capital gains. Now, this is different than profit income because you are not buying or making a product and selling it for a profit. Here, you have assets that appreciated in market value. You don't have much control over the value increase. But the great thing about capital gains is that taxes paid on this type of income are much lower than most other forms of income. Capital gains tax range between 15 to 20% depending on the amount earned, and they can go down to 0%, such as in real estate. In many cases, if you use your capital gains you got from a real estate property and you reinvest them back into the market, you might be able to pay no taxes at all. You are able to increase your net worth tax-free. When building our income, most of us know only one or two ways of creating income, but knowing the different types of income and how they are made gives us a better opportunity of adding different sources of income into our life. Question: which source of income sounds the best to you? And which one will you add to your income next? Make sure to leave your answers in the comments below. I always like to see what you have to say. As always, thank you for watching, and I will see you in the next video.